We have a very full agenda with two amazing speakers that we'll introduce in just a moment. So let's get started. My name is Kurt Lyon. I'm the Executive Director, Transform Finance. So glad to have all of you on the webinar today. It's going to be a really, really juicy conversation. This is the second webinar in our series discussing alternative ownership enterprises and now kind of expanding into a broader view of ownership to cover some real estate, some housing solutions that our speakers will talk a little bit about. And all of this is coming on the heels of the report that we launched last November. We have a real treat for you. Smitha Das of World Education Services and Santhosh Ramdoss of Gary Community Ventures are going to talk about their work investing in shared ownership models, all for figuring out solutions to the racial wealth gap. And in terms of the impact investors that we work with at Transform Finance, Smitha and Santhosh are really two of the folks who are walking the walk in terms of putting their money where their mouth is. Where can we really develop solutions with our capital that is driving systemic change, supporting models that really have the chance to build something completely new that is non-extractive, really community focused, and centering communities of color in the process. Just as a couple of matters of housekeeping, we have a couple instructions on the slide. Feel free to post questions in the Q&A throughout the webinar. We'll be keeping track of them and have ample time at the end to address them. It could be questions for us at Transform Finance, but hopefully also for our speakers, Santhosh and Smitha. And we also have the chat now enabled, so everyone can feel free to post commentary, talk to each other in the chat. We really, really love to see an active group here. We have closed captioning, so if you need instructions for that, it's on the screen. There's that CC icon. It might be hidden in the More menu with those three dots. So take a look there if you want to have closed captioning throughout the webinar. I think that's it. So I'm going to, oh yes, actually, wait, one more note. If you want to chat, there are two options in the chat. You can either post to everyone or just the hosts and panelists. So make sure you want to chat with everyone if that's your intention, or feel free to send us a message too. Okay, with that, I'm going to pass it off to Julie.
Thanks, Kurt. Hey everyone, my name is Julie Mentor. I'm the program director for transformative financing structures at Transform Finance, and thrilled to have so many folks here today. I'll just tell you a tiny bit about Transform Finance in case you're not familiar, and then we'll move on to kind of the meat of the conversation. So Transform Finance is an organization that has been around since 2013 and has really been working to do research, education, and implementation with the movement to transform finance. And what that means to us is really having investments follow three important principles, which are that those affected by investments have a chance to design the outcomes, govern the process, and share in the ownership of those investments. Then investors add more value than they extract, so essentially non-extractive investing, and that risks and returns are fairly allocated among stakeholders. And so over the years, we've worked around a number of issues, but our current focus is really around how do we shift wealth and control away from only shareholders to a broader set of stakeholders so that the economy can really benefit everyone. As Kurt mentioned in the beginning, we released a report in the fall. We're running a series of webinars. We have a lot more in terms of educational content on our website. So you can follow this link here, the bit.ly/AOE-hub, which will give you more information about our work broadly. But for today, we are thrilled to have two really leaders in shared ownership work, working both to as thought leaders, really thinking about how do we really transform this field, and also as practitioners, they're both really deeply experienced investors. So we have Smitha Das, who's the Director of Mission and Impact Investing at World Education Service, and Santhosh Ramdoss, who's the President and CEO at Gary Community Ventures. Thrilled to have them both today to really discuss how shifting ownership can help reduce the racial wealth gap, a really important topic and really exciting time on those topics. The reason why it matters is that really the racial wealth gap continues to grow. And you can see in this recent article from Brookings, the white households still hold just a vast majority of the wealth in the United States, and that gap just continues to grow. So a couple of just pieces from that article. Essentially, the smallest difference between Black and white family wealth was in 1992, and that just gap has just doubled since then. And that the main drivers there are we're looking and we'll really get into the details there, but various drivers of wealth, net housing, so housing equity and business equity have driven the largest portion of Black wealth in the last 3 years. But essentially the racial disparities, continue to throttle that growth because Black individuals own a home at much lower rates, and a number of other drivers, but essentially due to discriminatory housing practices, redlining, blockbusting, and then even further past in America's history of slavery, of discriminatory lending practices, the list goes on. So there's a lot of issues and a lot of problems to tackle here, and really excited to be sharing essentially what can we do about it? What can we do about it? So I'm going to turn it over to Smitha and Santhosh to share their perspective and their experience. And maybe to kick us off, I'd love to hear, Santhosh, if you could tell us, why does ownership matter when it comes to the racial wealth gap in the US?
Yeah, and thanks, Julie. And I appreciate the team at Transform Finance and you and Kurt really leading this work. And I feel like Smitha and I belong to a cohort of investors who've been quietly kind of obsessing over the idea of ownership and racial wealth. And we're excited now this is becoming a larger movement that you've all played a significant role in helping to catalyze. I'd say, from a Gary perspective, we're a private foundation and family office. And about 4 or 5 years ago, we started getting very obsessive about that racial wealth gap. And we're a place-based foundation, so looking at our own communities in Denver metro area. And traditionally, the perspective that we've had, and which is true for the sector as a whole, is to say that income is the primary driver of wealth, and that the wealth gap is an instrument of income gaps. And so let's put all our efforts in helping families of color grow their incomes in different ways, even reduce debt in their balance sheets, but primarily to think about income generating opportunities. And that's been the kind of history of this movement. And then what was shocking to us is to both talking to families themselves, but also looking at the data, that there's really a big mismatch between what we were trying to solve for and what the actual drivers of the racial wealth gap is. And turns out there's this whole ecosystem around owning assets that appreciate in value that has been the primary determinant of wealth creation in the United States. And so we had this hypothesis, and I think so did the team at West and a few others. And I will say the biggest kind of data points that have come out even more recently to backstop this idea is really some of the data that came out of the Federal Reserve in October of 2023, pretty recently. And they're quantifying the wealth gap between Black and white family, which is about $200,000, slightly higher than that. And they can actually break it down to say about 100,000 of that wealth gap comes from home ownership. It's primary residence or housing wealth. Another 40,000 of that comes from stock ownership, so owning stocks and bonds in your portfolio or owning equities. And then about 60,000 of that 200,000 comes from owning businesses and business value. And so it's very clear that the data that is as recent as a few months ago is indicating that when we think about the racial wealth gap in the United States, it's really an ownership gap. And then you look at the percentage of homes owned by Black folks versus white folks, the gap is about 30%. So essentially, you can take that $100,000 number and directly correlate to the fact that there are not assets in the family's balance sheets, especially for people of color. And that's the driver of kind of racial wealth. And that really shifts the frame in terms of how we use our assets and what solutions the ecosystem should be moving towards, and how do we kind of propel this movement forward. So that's what I would say is the kind of primary reason why this conversation is important. Smitha, I don't know if you want to add anything else in terms of context here too.
Yeah, no, that resonates a lot. And thank you again, Julie and Kurt, for inviting us to this conversation. I think for World Education Services, which is a nonprofit social enterprise, we're looking to invest off our balance sheet and ultimately align 100% of our resources towards the mission. When we were looking at advancing the mission, particularly economic social inclusion for immigrants and communities of color, we did also wrestle with this question of wealth, and it does actually end up being quite common sense. How have individuals historically been able to build wealth in the world? The data shows it. We all know it. It's owning assets, your own home, your own business. And so the question for our team was, how can we support tools that are particularly designed to unlock access to asset ownership for communities of color, immigrants, communities who have been often overlooked? And that is because there has been centuries of policies and programs that are particularly creating barriers, right, for communities of color to achieve home ownership through, say, redlining, achieve business ownership, financial asset ownership through lack of kind of credit programs. And so I think that's where we've particularly thought about that piece around the intersection between asset ownership and the racial wealth gap, and same with the solutions. I think as we go through the types of asset ownerships and the types of programs, many of these types of models are not new. What is new is bringing this intentional racial equity lens to the work and saying, how do we design programs that are particularly addressing the context that we're sitting in, particularly in the US. So happy to dig more into those solutions, but that is really what brought us to this work as well.
Yeah, thank you both. That, is a really important point, right? As you say, so often the focus is on income and not assets, when we know that assets is what actually builds wealth, and therefore the strategy needs to be really, really intentional in response. So, part of what prompted us to invite both of you to this webinar is a great article you wrote in Impact Alpha and kind of sharing this pyramid. So would love to hear, kind of if we're to get practical, but what does it mean to really be intentional and think about shifting who owns wealth? Would you mind just telling us more about this pyramid, and then we can go into some of the details? So Smitha, do you want to kick us off?
Yeah, absolutely. So this is something that we've been partnering with the Gary team and also many other investors who have been early on in supporting particularly ownership models with this lens towards how do we address the racial wealth gap or wealth inequality. And so what we've found, particularly through this ownership pyramid, which was first published within Impact Alpha, I see the link in the chat, is the way we structured this was showing the different types of assets one would want in a portfolio. So again, this is quite common sense. People in their historically, to build intergenerational wealth, have a portfolio of assets. How do we, again, democratize this portfolio of assets to those who have been overlooked? And so you can see across this pyramid, there's financial assets, home ownership or home assets, business assets through employee ownership, tenant equity models, and finally community ownership. And the reason why we ended up in this pyramid diagram is kind of it's going from the most modular sense of one financial asset to a home, to then a business, to then a community or neighborhood with the tenant equity model, to then ultimately a community. And so that's why it's framed this way. I think we've been kind of debating around whether we need to invert the pyramid and show that we need to have more kind of a stakeholder economy first approach here, but kind of bear with us on this version 1.0. And we're happy to talk through some of these models. I think what's exciting is you'll see some logos on the side where we show some of the investments that both the Gary team and Wes have supported and others have supported in the ecosystem. And there's many more logos actually to add to this. Impact Alpha and you all at Transform Finance just published this wonderful database of ownership models. And so definitely want that to be shared with the listeners of this webinar as well, because that's going to be a great resource. Would it be helpful for us to talk through some of the examples and particularly go into the different types of assets?
Yeah, I think that would be great. I think people would love to hear a little bit more about each of these
Yeah.
and how one might get started. What are some of the
Yeah.
things that you've found that you've been excited about?
Yeah, okay,
Yeah.
absolutely. So why don't we divide and conquer this? Santhosh, do you want to start with the first one?
Yeah, absolutely. And Smitha, if I may, I'll add a couple of quick contexts on the
Sure.
pyramid too. One is I think Smitha and I talked about it, and we've been asked why this is a pyramid, and she mentioned this. I also think that it's mindful to say that there's always ownership, and ownership has a relationship with power, and that the model is said to be somewhat of a pyramid, as she mentioned, because I think the more you have collective ownership models, the more we can have communities exercise power. This is an idea that we've not explored further, but I do think that intuitively, as you go down the pyramid, you go from things that you hold as an individual to things that you hold as a collective together. And how does that affect in terms of the interplay between ownership and power? And then the other thing I'll say is that one of the things we kind of aligned on is this idea that the power of ownership and wealth building should not be predetermined by the fact that you have to save a whole bunch of money to put it aside to build wealth. That you should be able to do that as part of what you do already. So in the part of individual financial assets, the solutions that I think are resonant is things like retirement plans and 401k access, and how do you universalize that to families so that as part of their own employment, people are able to get long-term access to wealth creation. The other big idea that I think is gaining a lot of steam around is this idea of startup capital for life or baby bonds, is how do we make sure that there is a savings account or a wealth account or a trust fund for every kid who's born in the United States. We've seen the examples from Connecticut. So the starting place of the pyramid is where most Americans also have wealth, which is stocks, bonds, and securities. And how do we universalize access to that? And how do we also make that available for those that don't have that intergenerational transfer of wealth available for them to kind of make that starting place? And then the second thing you see is are obviously the biggest driver we think in terms of wealth gaps, which is around real estate and home ownership. And home ownership tends to be one where we're starting to see consistent data that there's a significant opportunity to bridge that gap, but also significant gaps where even after persistent efforts over the last 40 or 50 years, the Black versus white home ownership gap is still about 30 points. I mean, the Black home ownership gap is about 40%, I think, and the white home ownership is 72%. So it really accounts for a significant chunk of it. And there we're seeing models where you have things like Landed or the Deerfield Fund, which explicitly support families in providing them down payment assistance. So acts like an intergenerational transfer, but mimics the structure of providing them a significant chunk of money needed to buy a home in terms of down payment. And then you have funds like Blackstar Stability, which is listed here, which is to take certain predatory contracts and turning them into more inclusive contracts for accelerating home ownership, particularly for families of color. And so we're excited about the space. I think it's a mature space, and I think there's a lot of opportunity there. Examples here are just a starter place, and there's a lot more. Smitha, do you want to talk about employee ownership?
Absolutely. So there's a lot of buzz, I would say, in the impact investing arena around employee ownership right now, which is exciting. There's a lot of new funds being stood up. There's a new pooled fund being stood up called Unlock Ownership Fund, which Santhosh and I are also involved in. And it's exciting to see just more momentum in this space. Again, these models are not new. Employee stock ownership plans have been around since the 1950s. What is particularly new is bringing this impact lens and saying, how do we use these models for distributed ownership of businesses and really bring frontline workers of color into that wealth building opportunity. So there's a few different logos here on the right in the employee ownership. Wes has invested in all four of these, and there's also even other funds that we support, like Mission Driven Finance and Boston Impact Initiative, that are working also in the employee ownership space. And so the universe is growing within our portfolio. But just to say, I'll speak to one, which is Apis and Heritage Capital Partners. They're using the model of an ESOP, again, a model that has been around for a long time, particularly using it in a way that blends the ESOP model with the principles of worker cooperatives, which is really focused on democratic governance and the ownership culture piece. And they are bringing the best of both of those models into their fund, Legacy Fund 1. I'm sure they'll be launching Fund 2, in the coming year or two. And this fund is particularly looking to acquire businesses that are majority workforces of color and convert them into 100% worker owned. So we've already seen a few deals from that fund, and Santhosh his team is also in that fund. And so it's just been exciting to see see the momentum of their model. We've also been planting many seeds with other types of employee ownership transaction types. It's not just an ESOP, although that's often the one that folks know of. There's also worker cooperatives or versions of worker cooperatives, taking that to scale. And then also employee ownership trusts, which is a version of a perpetual purpose trust, or PPT. And that's what Common Trust is bringing to market, actually, with their first fund. The first close is imminent. I just got the final docs in my email this morning. So that's a really exciting set of actors that we're looking to partner with. And there's actually very much a growing community of funds and players in this space looking at employee ownership with the intersection of the racial wealth gap. Santhosh, you want to talk about tenant equity, and then I'll bring us home with community ownership?
Yeah. And I think you can notice that in the pyramid, as we go lower, there are things that are still very early. And I think tenant equity is one of those things that has a 2 to 3 year cycle of innovation around it. And this really comes out of the idea that how do we kind of democratize access to wealth building? And so if you think about, I think about 40% of Americans are still renters. How do you make sure when you're renting a home or an apartment, you're actually generating most of the economic value for that property, but you're not getting any of the upside? This was the idea that our team was playing around with for a while. We kept calling it TSOPs, which is basically taking the ESOP language and putting a T for tenant in there. And then Enterprise pioneered a fund recently called the Renter Wealth Fund. And these conversations are happening simultaneously. So Enterprise has launched a $200 million fund where they're essentially going out and buying properties that are preservation deals. And for families in those properties, they get to start accrue a small share of the upside of the property on an ongoing basis. It's both paid out to them on a monthly basis, but there's also a significant upside that could be realized at the end of it when the property is sold or refinanced. So that, I think, is a fascinating approach of democratizing access to wealth. And we have another fund in Colorado called the Colorado Housing Accelerator Initiative that has done that. And the most exciting part of it is some of these ideas have fed into a statewide legislative measure that Gary was involved in helping to pass that unlocks about $300 million of permanent funding for affordable housing in Colorado. And part of that is every unit that's financed through that funding pool will require that the property manager puts in a tenant equity vehicle so that the renter can actually accrue wealth. So we're excited for this to be not just a private funded pool, but I think when affordable housing financing happens, we're seeing a model where every renter can be provided with a wealth account. And over a period of 5 or 7 years, this could become a $10,000, $15,000, $20,000 pool of money that can eventually potentially become a down payment for a home or whatever I think they want to start doing with it. So it's very early days, but we're excited for these models and we're happy to follow up and talk more. But it's really exciting to see that kind of structure come around the renter community and more broad-based ownership. Speaking of broad-based, I think we should talk about community ownership, Smitha.
Yeah, absolutely. So community ownership at the bottom of the pyramid, we're seeing models really across residential and also commercial use cases in the real estate space. And our first investment actually at Wes in the real estate arena was in Kensington Corridor Trust last year. It's a neighborhood trust model that's based in Philadelphia, and they purchase and maintain perpetual community control of local residential and commercial units. And they do so with the goal to preserve affordability and avoid displacement, which is a real risk in this area. And what they also do is they reinvest the income into neighborhood programs. And what Santhosh was saying at the beginning around the ownership pyramid is what we're excited about is also just the democratic governance structure and participatory governance structure they have. They use the legal structure of a perpetual purpose trust, which is the same legal structure that's used in the employee ownership trust that Common Trust is really demonstrating in the employee ownership space. So what we're kind of taking from that from Wes is we're trying to understand just perpetual purpose trusts broadly. It's a model that's really taking hold. Folks may have heard of Patagonia, for example, exiting as a perpetual purpose trust last year. And so it's just been exciting to see more momentum in that space, and trust models are having a moment both in the community ownership and employee ownership space. What they've done at Kensington Corridor Trust is they've basically merged the PPT with a 501c3 nonprofit operating partner. And so the whole legal structure is meant to enshrine the neighborhood trust and the values of community ownership in perpetuity. And so we're really excited about that model. And the last note I'll make on this pyramid overall is, as you'll see across these examples and different types of assets, that we're building a portfolio at WES across these different assets and across asset classes, as well as across the spectrum of capital. So some of our investments are looking at our competitive market rate returns, others are more catalytic and patient in nature. And so we're also doing something in between. And also, right, some are in real estate, some are through private debt, credit, equity. And so we're actually able to have a diversification of our portfolio by using this tool of the ownership pyramid, which we found really valuable.
Thank you. This is wonderful. And I appreciate really both the kind of the framework and then the specificity with clear examples that are, out there today that folks can invest in. And I appreciate you pointing out that it's a range of returns, right? Some of it is more, some of it is in the grant category, some is a lower return, some of it is definitely just market rate. So there's there's something for everyone in there. Maybe just one last question, and then we'll turn it to Q&A. So folks, just to, there's the chat button, feel free to keep kind of reacting and or introducing yourself. And then we're going to try to keep the questions to the Q&A if you can, just so it makes it easier to triage kind of when we get to the Q&A portion of this conversation. But before we do that, we'd love to hear Santhosh and Smitha, kind of what additional advice do you have for investors who are looking to get started, who may be thinking of like, wow, it's great, I have some examples, but like, how should I think about this? If I really care, what else would you tell investors interested in this strategy?
I'm happy to start. There's a lot to say on this, but I think one thing we haven't said yet is that there's a lot of responsibility we have as investors to really understand the value of these assets. It's not about unlocking ownership, asset ownership full stop. It's unlocking asset ownership of assets that accrue in value, right? And so that's what we've seen historically, that yes, Black and brown families have had access to assets, but these assets are not accruing in value. And that actually leads to a greater gap in the racial wealth gap. And so it's just so important for us to say, yes, maybe home ownership is an interesting model, but we really need to do our research as investors to understand the market dynamics. What Deerfield is doing in the Denver metro area makes a lot of sense, just given kind of the buttress that that housing market has versus others during moments like 2022 and 2023. And so I think it's really kind of, that's just another nuance of this that I don't want people to take away, like, let's just unlock asset ownership. It's ownership of assets that are accruing in value, right? And that's the pathway to wealth.
Yeah, and I love that, Smitha. And I think this is a healthy debate in the ecosystem to say that there's been a historically a more extractive asset class, which involves accessing ownership for low-income families that are predatory in nature. And we've seen actually capital structures that are built on that, and it's very lucrative for investors. But that's not what here we're talking about. I think we just really need to be mindful of designing solutions that does have the promise of wealth building. That being said, I think Smitha and I choose to, again, have conversations on the fact that there's always volatility with any asset, and that there is going to be an up and down, whether it's a home, whether it's a business, whether it's a stock or a bond or whatever it is. And how do you kind of both buffer and protect the families from that volatility, but also acknowledge that part of that conversation around wealth building is a conversation around risk. And often the reason why low-income families, and particularly families of color, cannot participate is because the fact that they don't have the luxury of taking the level of risk that we need them to take. And so I think it's also challenging if you want to completely protect them from risk. You're not then protecting them. You're not giving them the full opportunity to go out and build the kind of wealth that white Americans have built for generations. And so I think there's a nice balance here. I think it's a healthy debate that the ecosystem needs to have. And the Deerfield Fund was incubated by Gary, and we often had questions early on about nudging people into home ownership, and the question of whether that's responsible or not. And even within the first 18 months, we've seen an average Black family in the fund increase their net worth about $30,000 in a housing market that's been volatile. But as Smitha mentioned, I think the Denver Metro is a very stable housing market. We didn't see much of a downturn in 08, so we were able to say confidently, let's do that. But that may not be true in a lot of other geographies. I think there needs to be a healthy debate as investors look into it, is that how do you actually responsibly diligence these opportunities to understand if this is meaningful ownership or not?
Yeah, and some of those types of ownership models are also passive and some are more active, right? You're in a job, you're in a home. How do you start using a tenant equity model or a home ownership model to get on a path for wealth building, or join a worker cooperative, transition a company to a EOT, employee ownership trust? So there are some models which maybe has less risk potentially, but there is also the perception of risk, because what we see, even in some example, all of the funds we've invested in, there's still an opt-in for workers, right? So there's a lot of financial literacy and just kind of unpacking the potential risk of these models, because there is a lot of mistrust, rightfully so, in these communities, because these models do often seem too good to be true. And then that has led to things like the world that we live in right now, right? And so I think that's part of this work, is also building this relationship of trust with community and us as investors.
Yeah, I love that. I remember the story when we launched the Deerfield Fund. The first client who came on board, we got a phone call back, and her question was, "Is this for real? Like, you all want to give us $40,000 to buy a home, and you don't want a monthly kind of repayment, and you just want me to pay it back when we sell or refinance the house?" For them, it was even like a deep sense of distrust to say this can't be real. It's some kind of a pyramid scheme. Not to use our pyramid, sorry. The other consideration, I think, Julie, for investors is how do we center this around race? And the conversation, I think, is going to be diluted if you think about ownership more broadly. I think the discrimination in terms of access to ownership has been the primary determinant, I think, of the way the inequity has been really built out. And so a group of investors, including Smitha and us, believe that opportunities that we have to center opportunities for specific groups that have been discriminated against is going to be really, really important. In my mind, I think that the ownership conversation is like the best kept secret of American capitalism. I think people who built wealth kind of know it, and then people of color have been kept aside from it. And so if you want to really change that equation, we have to over-index for communities of color. There are models where you explicitly design your program such that your employee ownership fund invests in companies that have disproportionate employees of color. And then there's models like Deerfield where we explicitly call out race, that you can only apply if you're a Black family, and otherwise you're not eligible. So there's all kinds of designs that we can take on. And I would say, but investors would be doing disservice to the movement if they care about the racial wealth gap by not investing in funds that at least have some kind of bias towards calling out race.
Yeah, wonderful. And I really appreciate, it doesn't happen by accident. If you just do asset ownership, you really need to be intentional in terms of who benefits, because the obstacles to overcome, the history and the centuries essentially of discrimination have to be actively countered. And making sure it's not the wrong kind of pyramid scheme. I really appreciate that. Yeah, thank you so much. I feel like this is a great intro. And yeah, let's shift to, we're getting a ton of really great questions, so we'll get through as many of them as we can. And yeah, kind of always there's a lot here. It's a really rich field. So hopefully this is a way to open people's perspectives and the start of many more conversations. So maybe to get us started, there's a question in the chat about steward ownership, right? So often folks who come in to think about ownership, there's employee ownership, steward ownership, and Smitha, you talked about PPTs a little bit. But I'm curious if you have a perspective in terms of profit sharing mechanisms like an employee ownership trust versus more asset ownership models like ESOPs. and how you think about the fact that in, one model, there's, essentially employees have access to the underlying wealth of the company, but then it can be sold and they might lose their jobs, versus, a company being kind of perpetually held in a trust or in a more steward model. So curious kind of on the employee ownership space, if there's a little bit more color, maybe Smitha, you want to share there.
Sure. I mean, I think that the way we're looking at it is really more of planting many seeds across the different types of ownership structures. I would say I would kind of be cautious to say one is better than the other at this point in where we are in the field. I would encourage folks to actually continue to have this more experimentation mindset and learning approach to ownership economy writ large, but particularly with some of these models around steward ownership, I think time will tell. And that's why we've actually invested in such a diverse set of funds and even directs to just understand what's the implications for wealth building and also power sharing. We're actually at West particularly excited about that intersection. Our 4 investment themes are opportunity, wealth, power, and justice. And we think about those quite fluidly, right? So there's a lot of investments in the ownership economy that also are very much shifting power structures and elevating worker voice, worker power. And we're actually particularly looking at models like that. And so steward ownership fits that space well. But we're still playing that out. And there's also other models that don't necessarily have too much of a power sharing approach. Really a pure play ESOP is really just a wealth building tool. It's really an alternative to a 401k, if you will. But what you see with, for example, the APIS and Heritage example is they're bringing in the democratic governance principles of a cooperative. And that's what's unique to kind of evolve the model of an ESOP to include more power sharing approaches. So anyway, just to say that I'm cautious to answer that, and I hope folks don't answer that question just yet because we're still in a learning mode. And I think we need to give these models some time, right? A lot of these funds that were on that PowerPoint slide were all first-time funds, often first or second-time funds. And so we need to kind of get a few more reps and years to understand. So that's my perspective. I don't know if Santhosh, you feel differently.
No, I think I would say yes. I think we need opportunity for 1,000 flowers to bloom here. We're still such a tiny corner of this market. Mainstream capital doesn't think about ownership. They don't think about ownership only for the ones who want to make the most amount of money. It's very clear who owns wealth there. And so if you want to kind of democratize this movement, we also need to democratize in terms of access and in terms of capital. But this tension between more stewarded, more long-term community wealth mindset compared to more short-term individual wealth is a tension that will continue to exist. And it's a healthy tension to embrace, and I think it's a healthy tension to invest in. I mean, and the same thing plays out on the home ownership side, where when we were launching Deerfield or more broadly in that ecosystem, a lot of us were like, but if Black families are buying these homes and then selling them after 7 years, they're participating in making it expensive for everybody else. And then there's like the community land trust model where you could buy a home and it's subsidized, but also your upside is capped. And that is appropriate for a lot of folks who are at an income level where they can't afford to buy a home in the open market. But when we went and did focus group discussions with Black families, they're like, we don't understand why we should leave upside out on the table and we should be compromising where my upside is capped when we know that our neighbors who are not Black are making multiple times the wealth in terms of home ownership. So I think we also need to be responsive to the needs of what specific folks who are participants in this want. And I think that there's a wide swath of people who are participating in the ecosystem. So I totally align with what Smitha says, is to say, let's not pick sides, let's invest as much as we can and bring dollars into the ecosystem, because that's what really matters.
Yeah, I think that point of like what participants actually want and the folks that we're hoping to support actually want, right? We don't want to reproduce the paternalistic, condescending, like, we know what is best for you, let us come and save you. But instead, right, the point is agency, as you mentioned earlier. And I'm curious because you mentioned, both of you, I think Santhosh earlier and Smitha just now, this question of power. And I feel like we haven't, we've really focused here on wealth building, but I feel like it may be worth just touching on power just a little bit more, and how you see that question of individuals and communities building power as a dimension here, because I feel like we haven't addressed it quite explicitly, but maybe let's take a minute to do so now.
Smitha, do you want to kick us off?
I have a lot to say on this, so I was wondering if you wanted to. So we think deeply about how we can shift power to those closest to work, to communities, across all of our work at WES, and so it's something that we're always talking about. I would say here there's and this really ties to the transform finance model, right? Thinking about stakeholder capitalism. How do we actually use these tools to shift power where, right, that using a pyramid architecture, right, often power in enterprises that they've been structured have the pyramid structure, and how do we actually think about elevating worker voice, particularly frontline worker voice and power, to think about democratic governance of enterprises, of communities, of society. And that's something that we're really excited about across all of these models. And anyway, so I have a lot to say on this. I don't know where we should go, but Santhosh, what are you thinking?
No, I think that it's a dimension that it's easy to forget because we can get obsessive about money and the capital part of this, and which is where I think sometimes I'm like, okay, let's just think about keep building wealth, and you got to care about the balance sheet. But the dimension of power is, I think, fascinating because it has a lot of democratic impact in terms of how societies are built and how civic participation happens. And from a Gary perspective, because we're a place-based funder, we've been looking at Denver Metro or Denver as a city. And we've seen that, for instance, in the city of Denver, there's been probably between 50 and $100 billion of wealth that's created even in the last 5 years just in the real estate sector. And then you start to wonder, where does that wealth accrue and who can really participates in the prosperity of the city? And so then you start to see the level of engagement, love that people have for the city changes when they actually own a piece of that prosperity. So I do think that there's a strong relationship between financial incentives and the level of ownership that you have. And flip side, I think most policymakers here in Colorado, but more broadly, are making decisions primarily for homeowners. It's like really shocking to see the disproportionate number of participation and like the voice that homeowners have in conversations as compared to renters, which is also, the flip side of it, which is where the whole political system is designed around ownership, that we're designing for people who we think are going to be who we've always valued. And there's obviously racial bias in that too, but I think we need to shift all of that. So maybe the renter equity piece or the employee ownership piece, all of those conversations are going to start shifting power. And that, I think, is going to be dramatically powerful as we think about a more, I think, accessible system in terms of civic participation.
We haven't talked about this fully, but there's a lot of other benefits to employee ownership models beyond the wealth building. It's actually leads to greater retention, to more productivity. It has other benefits. And even for the worker, better benefits for them, right? It's not just the wealth piece and your income. It's not just the kind of, if it's an ESOP, that you get the 501k equivalent through a retirement account, but it's actually also increased wages, right? So you're actually just having better quality jobs as well. And there's often, in any business or leadership book, you often talk about an ownership culture and how that's best practice. And so I hear one of our partners at Project Equity, Allison Lingane, often say, what's the best way to create an ownership culture? It's giving employees ownership. And so again, a lot of this is common sense. I think we know this. And what is exciting is that we're starting to see some investable products to demonstrate it. The last piece I'll say on this idea of power sharing is just that we are also seeing that many different investors are coming to ownership for different reasons. And I think that's great. You don't have to come to it from the same lens that Wes is coming to it, or Gary. If you're coming to it from a stakeholder capitalism perspective, or quality jobs, or racial wealth gap, or shared wealth building, or shared power shifting, right? Like there's a lot of different aspects to this work. And I think that's great because it can crowd in more capital based on motivations that you all may have.
Yeah, it's a really good point. It is kind of something that's really unique about this space, is that it aligns a lot of different interests. This piece of power, just to tie to a couple things. One is, in the report that we did, really, we really want to make sure to highlight ownership comes with essentially rights to wealth, but also rights to govern and rights to decide. And often those are thought of as together, but they can be separated. And it's really often folks think about the wealth, but the governance piece and the ability to control your own destiny is actually huge also. So really important to remember that. And just to loop back, I think, Santhosh, you just made a side kind of a comment earlier about the policy in Colorado and how impactful that was in terms of really accelerating tenant equity, right? So the connection to power building isn't just like abstract, it also is, well, then you can get policy in place that can help further accelerate and systematize some of this work. So that's part of what, you know, kind of what it ties to. So just to connect a few pieces there. But shifting, one of the questions I know a lot of folks asked, and someone asked here is, you know, we talked about it's important to be explicit, right? You can't just have a neutral ownership strategy and expect it to benefit communities of color. And so someone asked, you know, how has the Supreme Court ruling impacted your ability to target using race?
Yeah, I can jump in here. I would say, you know, the movement as a whole, if you do care about racial wealth gap, I think this is really like an opportunity to double down and not back down. I think it's easy to overreact to and have a sense of fear. And I think if you do that, you're doing the work of the folks that want us to stop doing this for them already before they actually even ask us to stop doing it, which I think is, you know, which is true in a litigious society where there's institutional fear, and Gary as an institution, you know, we also have institutional fear that, oh, what if this happens? What if that happens? The truth is that the foundation of a lot of the work we do has been built over the last 50 years, and it's enshrined in the legal framework. It's laws passed by the Congress, and it's all been in the book. So a majority of race-based focus doesn't come from explicitly focusing on race. It's also working in ecosystems where there is a significant number of people of color who can be benefiting from it. Right. So affordable housing, for instance, when we do tenant equity, turns out a disproportionate number of people of color, especially Black and brown families, are the ones that are primarily renting. So they're going to propose. Similarly, in employee ownership, a lot of these companies that get converted into employee-owned companies are often long-term cash flow generating businesses that are disproportionately employing workers of color. Right. So there's natural sense of concentration where opportunities can be done, and there you don't have to worry about litigation. You're doing what you already do, and you're protected very well within the realms of what private capital can do, right? The challenge is also when we explicitly call out race. In the case of Deerfield Fund, we use something called a special purpose credit program, and this has been, again, in the books for 40 years. It's not totally new. And it explicitly says that if you know a group is being discriminated historically, and if you can make the case for this kind of discrimination, which we know is true, then you can design programs that specifically for the benefit of this ethnic group. So SPCPs are a great tool. I think that more people should leverage it. And it's designed specifically to solve the problem of discrimination, but also in terms of turning it into a wealth creation and wealth building tool, I think is the innovation that's going to happen. Obviously, the bigger question is how safe are SPCPs, and are they going to come after that? And I think that's definitely an existential threat. And I would say we should all be aware of it. Yes, so I don't want to like undermine the fact that this is really a scary moment in terms of the ecosystem, but I also feel like this is the moment we all need to come together, and I think to stay saying that let's double down and not back away from it, because you're already seeing squeamishness and commitments being reneged, and that is just not healthy for the ecosystem, especially given the gains that we've made in the last few years. So that's where we're coming at it from, Gary.
Yeah, that resonates a lot. I mean, I think it is a time for leadership here, and to double down. And so at Wes, we have been tracking the multiple lawsuits very closely, and also advising a lot of our 25 investee partners to see how they're also navigating this and making sure they have the right resources. What we've found is that there are ways to design our kind of legal agreements to say that we are supporting underserved, underrepresented, often overlooked communities, e.g. migrants, communities of color, right? There's ways to protect yourself from a legal perspective. I think that playbook is there. If folks have questions, happy to share the language that we've at least been advised to use. And many impact investing membership organizations are having calls around this. So there's resources out there, webinars out there to understand better. But I also think this is really a time for leadership, and we need more folks to double down, as Santhosh said.
Yeah, thank you. Yes, here, time for leadership. Maybe touching a little bit on like other ways to think about this. I'm curious, someone asked if there's if sector is another way to think about the pyramid model. So for example, sectors where there's a lot of precarious workers, workers of color, home care, childcare. Is that a dimension in how to think about the pyramid, and potentially also to have it be like, oh, we're focused on childcare workers, not necessarily race, as a way to get around some of this risk?
I think that already, sorry, go on, Smitha.
No, I think that that's already embedded in a lot of the strategies of our funds, particularly those that are looking to transition businesses that are majority workforces of color. That leads us to maybe convert businesses that are in the landscaping space or in nursing, care economy, food processing, right? So we're seeing already some concentration of the types of industries that are being converted to employee owned with the overlap of the racial equity lens.
Great. Yeah, thank you.
We also often see geographies as proxies as well for Black accessibility, for Deerfield, right? For all more of our real estate home ownership type partners, we're seeing focus, right? The Kensington corridor is a 1 mile corridor in Philadelphia that is majority migrant. And so that is often a proxy as well.
Yeah, thanks. Yeah, super, super helpful. And to add the geographic dimension, of course, and to that point earlier you all made around appreciating assets, connects to it all, kind of like connects together. I think we might have time for one last question. Do you see evidence of networks of investors, donors coming together to co-invest, collaborate around these kinds of models? What are you seeing in terms of the investor landscape for this?
I think we are there. I mean, right now the network is kind of small, and we often call ourselves ownership nerds, or I call myself ownership nerds and other people.
He's called me that many times.
And I think that the beauty of the movement, honestly, Julie, is that we didn't intentionally, come together and say, let's do this. I think the work really informed the strategy, and we all saw the power of what we're building. And I think a lot of credit goes to incredible folks that have been building these capital tools, whether it's Project Equity, Apis and Heritage, a whole bunch of other ecosystem players across every one of those categories. And I think we all came together and we realized we were LPs in these funds, or we've partnered with it, and then there's a framework around which we were starting to coalesce around. And it tends to be more impact-oriented, racial equity-focused investors. I think the movement we are excited about as the next phase of this is to really bring in more mainstream investors. And even in our own portfolios, we have the investment in an employee ownership fund like Apis and Heritage, but we also have investments in mainstream private equity funds. And I think the conversation we should be having is go back to those private equity funds to say, well, are you thinking about ownership? Have you thought about broad-based employee ownership? There's a significant alpha here for you to get an upside out of it. But at the same time, I think we would not be investing in Fund 3 if you didn't think about ownership pretty actively, right? I think that asset holders, particularly endowments and family office, we would love for a future where this doesn't get kind of sidelined as this really nice separate thing we do, but goes into the mainstream conversation, because essentially every endowment, family office, asset holder has some real assets in multifamily housing, has some private equity, has some venture. And all of these assets are really about ownership by the end of the day. And how do you share a small sliver of that in order to make multiple excess return for like low-income families and families of color, I think is the story. I don't think we're there yet. I think that's the next phase of this movement, I would say. And I think it's also important to show the demonstrable solutions that we've had through the funds that we have assembled here. So that's what I think we're excited about. I don't know, Smitha.
I think building on your point, you were kind of talking about how ownership could be a theme or a lens across multiple asset classes. And that's exactly the language we've been trying to bring to the ecosystem, because we don't want it to be isolated as this is a particular allocation that you may have as a asset allocator. Rather, it's a strategy that you can embed in real estate, in private equity, etc. And so that's what we need to be shouting for the rooftops. So for all of you listening, please share that with whoever you're working with, because we just need more capital flowing.
And I love it because I think one of the critical moment here feels like the critical moment in climate lens investing or gender lens investing. And those have become more mainstream in a way, at least climate lens investing is. So even a non-impact investor is sitting down with a with a manager to say, well, what are you thinking about climate? Because it sounds like that could be a challenge. How do we change ownership lens into an existential future question about if our wealth is not more fairly distributed, this society is not going to survive? I know that's very catastrophic, but in reality, that is true in terms of. So I think there is a moment where we would love to see, as Smitha was mentioning, ownership lens investing as the future of how we think about this movement, so to speak.
Yeah, exactly. As a layer through everything, not just necessarily something that's on the side. That's all the time we have for now. So we're going to share just a couple of next steps. We'll put a survey we'd love for you all to fill out. And then I'll hand it over to Kurt to share a little bit just about what's up next.
Yeah, awesome. This is such a great discussion. Thank you so much, Smitha and Santhosh. As usual, just great to be in the same room with y'all. Fortunately, this is not the last time we're going to be talking about ownership and alternative ownership enterprise and all this work that we're all trying to figure out here. We have a webinar coming up March 6th with the Donut Economics Action Lab. This is really special for us because Deal was actually the original thought partner with us behind this, the report that came out, the alternative ownership enterprise work that we're doing. They do really awesome work with business leaders on designing business models fitting within planetary boundaries. For those who aren't familiar with Donut Economics, it's a book in theory by Kate Raworth, an economist, around building kind of a whole new framework on how we should be organizing our economy to be in line with the planet and really being sustainable in building blocks of the economy. So we're also going to be hosting another webinar sometime in March, so stay tuned for that. But you can register here with this bit.ly link, but we'll also send an email out to all of you. And then Julie, if you want to go last slide. So yeah, we mentioned this survey. Please, we'd really love your feedback. It's not just for, letting us know how we did. It's actually for designing our content going forward. We really want to produce stuff that is relevant for you all and is really hitting the topics that is most important to our audience. So definitely take a look at that. And then if you haven't yet, we have a collection of resources on our website. There's another bit.ly there for our Alternative Ownership Enterprise Learning Hub. So yeah, thanks everyone so much. I see there's some chat around the bit.ly. We will send links in a follow-up email to everything here if you have any issue accessing any of these links. But yeah, I guess we'll end it there. Thank you all so much for being here.
Yeah, thank you again, Smitha and Santhosh, for your time and your expertise and your work. We're really just so inspired by your leadership. And thanks everyone for the great questions. Sorry we didn't get to all of them, but it's the sign of a good topic when we don't get through all of it. So really appreciate this as the start to more and deeper conversation on these important topics. Thank you, everyone.